So in this Excel file, I have gone through several examples of accounting for leases. And so in the next 2 or 3 videos, I'll walk us through what we need to do. And just so you know, I assume you've already seen the introductory video that I put on Canvas. So if you haven't looked at that, stop now and go back and look at that, because there's foundational information there you need to have. So what we have in this situation is Connor Company, the lessor, leasing a piece of equipment to Vaden Company, the lessee. The lease payments are $16,115 a year. The term of the lease is 4 years. The implicit interest rate is 5%, which is the rate that Connor Company used to calculate the lease payments, and Vaden is aware of that interest rate. We're assuming for this scenario a 0 residual value. The equipment is expected to have no value at the end of the 4-year lease term. Its cost to Connor Company is $40,000. Now, a few additional pieces of information. The lease is non-cancelable. The estimated useful life of the equipment is 4 years. At the end of the lease, the equipment reverts back to Connor. So Vaden will give it back to Connor, and there is no purchase option available. These are pertinent pieces of information for purposes of running through the finance test. So let's do that, because before we can do anything, we need to know if we have a finance lease or an operating lease. So the first piece of information, we know the lease is non-cancelable. If that were not true, then there would be no need to go through the 5 tests, because the lease would automatically be an operating lease. Since it is non-cancelable, we need to walk through the different tests. The first test, you'll remember, is that the asset is transferred to the lessee at the end of the lease. We know that is not true, because this assumption right here indicates that the equipment reverts back to Connor at the end of the lease. So that test is not met, so we need to move on to the next test. The next test is the bargain purchase option, that purchase option that is such a good deal that no one would ever not take advantage of it. In this case, there's no purchase option at all, so we know that is not met. So far, we've failed the first 2 tests for a finance lease. But again, keep in mind, we only need to meet 1 of the 5 tests. The third test is the economic life test. It says the term of the lease is 75% or more than the estimated useful life of the item. In our case, the term of the lease is 4 years. The estimated useful life of the equipment is 4 years. So we have met this test. The lease term is 100% of the estimated useful life. We could stop here, but just for illustrative purposes, let's continue through the remaining tests. The next test is the present value of lease payments test. This is where the present value of minimum lease payments is at least 90% of the fair value. So in this cell in B18, I have calculated the present value of the payments of $16,115 for 4 years at 5% interest. Also notice in my formula that I have included 1 at the end. Remember that 1 or 0 in an Excel present value calculation indicates whether you are dealing with an ordinary annuity or an annuity due. In our situations in the past, when we were dealing with interest, invariably it was an ordinary annuity, because interest is typically paid at the end of the period to which it relates. In contrast, leases are typically paid up front. So I'm going to make my lease payment at the beginning of the period that I am buying the right to use the asset. So we have an annuity due, and therefore I've put 1 in there. Be careful with that because we're typically used to ordinary annuities. So present value of minimum lease payments is $60,000, which is equal to the fair value. So that's greater than 90%. We have met that test as well. And then the last test is the alternative use test, which says the equipment is so specialized there is no alternative use at the end of the lease. It's safe to assume in our scenario with a 0 residual value that there is no alternative use. In other words, the equipment has totally lost its value by the time the lease is over. So again, we only needed to meet 1 of those tests, but in this particular example, we met 3 out of the 5. So without question, we have a finance lease. So I have the journal entries for both Vaden, the lessee, and Connor, the lessor, and let's walk through them. Let's start with Vaden. On January 1, 2020, which is the inception of the lease, Vaden will debit right of use asset for the $60,000 present value of minimum lease payments and credit lease liability for the same. Now, remembering that we make our payments at the beginning of the period, the first payment for $16,115 is made on that same day. So right after we record that, the asset and the liability, we're going to debit lease liability and credit cash for the first payment. Notice there is no interest associated with this payment because no time has passed as of yet. End of the year rolls around, we are going to record interest for the year 2020. Now, if you move to the second schedule in this file, I have prepared amortization schedules for both Vaden Company and Connor Company. Vaden Company, we start on January 1, 2020 with the $60,000 lease liability. We make a payment immediately, which will reduce the lease liability. Then by the end of 2020, we will have incurred 5% interest on the new balance, the $43,885. That is where our 12/31 entry comes from, interest expense and credit to interest payable. The other thing we have to do on 12/31 is, since we're carrying this asset on our books, we have to amortize that asset. Typically, we're going to do that using straight lines. So you'll notice I've debited amortization expense for the cost of $60,000 divided by the 4-year life. And then I've credited the right of use asset. Come January 1, I make my next lease payment. And you'll notice I am paying off debiting the interest payable. And then my credit or debit to lease liability comes again from the amortization table, which I calculated by taking the lease payment minus the 5% interest. And then as long as we're here, that's going to reduce our lease liability. Then the next year, I will take interest at 5% of that new balance. Reduction of lease liability being the difference between the payment and that interest. And then finally, our last payment will consist of interest based on the remaining liability amount. All right, going back to our journal entries then, the lease liability debit came from the table. We credit cash for $16,115. Then for the remaining years of the lease, we are effectively doing the same thing. 12/31/2021 will debit interest expense for $14.98, which again comes from the amortization table, and credit interest payable. And then we'll record our amortization expense, which using straight line will be exactly the same entry. January 1, we'll debit interest payable, debit lease liability, credit cash. 12/31/2022, where we will record our last year of interest and amortization expense for the year. January 1, 2023, we will debit interest payable, debit lease liability, and credit cash. And then at the end of 2023, I should have a year there, day, we will, at the end of that year, we will record our last amount of amortization expense. That will have effectively written off the right of use asset. We will have effectively paid off the lease liability. December 31st, we'll give Connor the equipment back, and we are through. Now, Connor Company's journal entries are pretty much a mirror of that, with a couple of exceptions. We're going to debit lease receivable. We're on the receivable end. We will credit sales revenue effectively if this is an installment purchase for all practical purposes. Then for Connor, it's a sale. And so they're going to debit lease receivable and credit sales revenue for the fair value or the present value of the minimum lease payments. And then they'll debit cost of goods sold and credit inventory for the cost, just like they would in a normal sale. Then on that same day, they'll take the first payment, and so they'll debit cash and credit lease receivable. And then 12/31 and January 1, throughout the life of the lease, their entries are effectively going to be the opposite of Vaden's. We're going to debit interest receivable and credit interest revenue for the amount from the amortization table. I've done two different amortization tables for the two companies. In this scenario, they are exactly the same, but they would not always be. So we'll get to that in a future example. Then January 1, 2021, we debit cash, credit lease receivable, and interest receivable, respectively. Note that at 12/31, I had no entry for amortization expense. The asset is on the books of Vaden. They're the ones that are going to amortize that, not us. Then throughout the remainder of the lease, our entries will be the same. On 12/31, we'll recognize interest based on the amortization table. On January 1, we will collect the cash, crediting lease receivable and interest receivable. And then same thing, 12/31/2022, and January 1, 2023, we will collect our last payment. Now, 12/31 of 2023, we will collect or take back that piece of equipment. However, remember, it had no residual value, so there is nothing to record because there is no value related to that equipment. So it's just a matter of taking back the equipment and determining how we will get rid of it. Okay, so the other examples we'll look at in a different video.